Welcome to Farm Credit Canada's 2026 Economic Outlook. Welcome to those of you that are watching this event live today, January 22nd. And if you're watching a recording of the event, thanks for joining us. My name is JP Gervais. I'm the Vice President and Chief Economist at FCC. And soon I'll have the pleasure of introducing my colleagues, but I would like to begin with a land acknowledgement. We're meeting virtually today, and wherever we find ourselves in Canada, we are on traditional Indigenous territories with rich traditions, stories, and histories that should be understood and honored. And it is our commitment in the spirit of reconciliation and collaboration to honor Indigenous peoples as vital contributors to our society and respect the diversity and strength of all the Indigenous people across this country. Now, there's a lot to cover over the next 60 minutes. We obviously the geopolitical events are going to capture quite a bit of attention today, but there are also what I would call fundamental trends in very different ag and food markets. And we need to as well kind of just put it all together for all of you to build what we would call the story for the operating environment in agriculture and food markets. Now, we're not going to have the time to get in a lot of details, but the good news is that you can always go to our website at fcc.ca/economics and look at a number of different specific detailed outlooks that we publish basically on a weekly basis. You can even register and leave your email address so that whenever an outlook is published, you get a notification directly to your inbox. So those specific outlook that we've started to publish recently, and we're going to continue doing this through the end of January and February, are going to provide a lot more details when it comes to pricing of different commodities, comparisons between prices for 2026 or forecasted prices for 2026 relative to previous years, and those type of things. So thanks for joining us. And what we're going to do is to start at a very high level and talk about macroeconomic trends, mostly thinking of the economic variables that matter most for your bottom line. So I'm going to introduce my colleague, Christian Rangasamy. Christian is a principal economist at FCC. Christian, how are you?
Good afternoon, JP. Good afternoon, everybody.
So Christian, last year we did the exact same thing. We kind of started out the 2025 outlook at the time, about a year ago, and kind of just thinking of the same questions. And I recall the forecast for interest rates, because at the end of the day, when we're traveling across the country, interest rates is kind of the most popular topic, I would say, that people are talking about. And I remember that our forecast, I'm going to give ourselves an A, or give to you an A in terms of the ability to forecast interest rates, because our forecast for the end of 2025 was the Bank of Canada rate at 2.5%. Now it stands at 2.25%. So if you think of the economic environment overall and the possible connections to the Bank of Canada rate, what do you see in 2026?
Yes, you're right. Last year we had forecast of interest rates for Canada that were lower than consensus expectations, and as you mentioned, those forecasts were not too far off from what actually happened. For 2026, we're again lower than consensus on our forecast for interest rate and also GDP growth. I'll explain that in a minute why that is the case. We're concerned about Canada's growth prospects largely because of America's trade war, right? So we know the Canada-US-Mexico agreement, or CUSMA, will be reviewed later this year, and it's unclear if it even will be renewed. So tariffs are not going away anytime soon. That's the bottom line. And if 2025 is any guide, look for that to exert a heavy toll on our tariff hit exporters, right? Like things like steel, aluminum, and so on. But let me show you a chart here that shows the damage, right? So, and when you're looking at this chart, remember that the majority of our exports to the US is tariff-free, thanks to CUSMA. And yet, outside of the energy sector, our exporters have really struggled, right, since the US tariffs were imposed. When you look at the third quarter of 2025 compared to before tariffs were implemented in the first quarter, basically most export categories are down, right, including tariff-free categories like farm fishing and intermediate food products and consumer goods. So perhaps that has to do with some exporters finding out that they do not meet rules of origin requirements and are therefore not CUSMA compliant. Another explanation is the fact that the US is increasingly getting its imports from elsewhere, right? So that's why I wanted to show you a second chart, which basically shows you that our share of the US market has been declining, right? So 30 years ago, that's the next chart. Yeah. So 30 years ago, you could see that Canada's share of US goods import was around 20%, right? Last year, our share of US market was roughly 11%. So that's the lowest ever. So you have basically a decline of 9 percentage points over 30 years. And the largest beneficiary of that was Mexico, right? So Mexico saw its market share in the US grow by 6 percentage points over that 30-year period, right? So right now, the last time I checked, it was 15%. We're at 11. So what I'm trying to say here, to highlight here, is that it's never a good sign when your biggest customer is finding alternative suppliers, right? So last year, more than 70% of our goods exports went to the US. That's why it's super important that Canada diversifies its client base. And we've seen this, especially this year. But but signing trade deals is fine, right? But it's not as easy as it sounds, right? So we have trade agreements, free trade agreements with 51 countries, and yet we have not been able to materially reduce our dependence on the US, right? Part of a reason for this is the fact that we're not capitalizing on opportunities presented by those trade deals. And I can give you an example here. Canada signed an agreement in 2017 with the European Union, right? I think it's called Comprehensive Economic and Trade Agreement, a very impressive name. It was certainly impressive for the European Union because over that last 8 years, they've exported, right? The exports grew by 40% to Canada. Our exports to the European Union have barely budged over that 8-year period, right? So we're struggling to even take advantage of the trade deals we've got already. So why would anybody think new trade deals will immediately boost our exports, right? So bottom line here is that it's not looking great on the trade front, at least over the near term. So that's on trade. The domestic economy is also an area of concern for us, right? So part of this is because of a trade war, which has effectively caused business investment to dry up. So we know that based on the data we have. And the thing is, we don't see much of a rebound in 2026 in light of business confidence still being really low and ongoing uncertainties with regards to the extension of CUSMA. And also part of a weakness, and that's super important for the domestic economy. So not just investment, it's also the consumer, right? So that's 60% of GDP. So we know there's weak population growth, record high debt, and a challenging labor market, right? So we know the jobless rate climbed to 6.8% in December. And so all of that should weigh on consumer spending this year, right? Burden of debt service, which already absorbs more than 14% of household disposable income. Well, that's unlikely to improve much, considering that a large share of households that are renewing mortgages in 2026 will be doing so at higher rates than at origination, which is 5 years ago when they originated the mortgage. And this chart that you can see on the screen right now, this comes from the Bank of Canada, and it tells a story, right? So as you can tell, on average, mortgage payments will increase by about 6% this year. But for those people, those households that are renewing their fixed year 5-year mortgage, which by the way is the most popular mortgage product in the country, well, for those folks, payments will increase by about 20%. That's quite a shock, right, for those households. And that's why I think consumption growth could soften a bit this year. And again, that's about 60% of GDP, right, which is about to slow down. So it's not all negative though. So there's one positive for the Canadian economy is that the federal government is stepping up to the plate with ambitious public projects, and we've seen the announcements, right? And those announcements have potential to rekindle business investment, private business investment. But one thing to bear in mind is that those large-scale capital investment, they're not as straightforward as it sounds, right? Because if history is any guide, disbursements can take a bit longer than originally planned. So don't get me wrong. We expect like those projects to boost the economy, right? Investment in Canada, but it's probably not a 2026 story, right? It's probably something more like next year or even 2028. So all in all, if you consider those twin challenges, basically from trade and on the domestic front, we think Canada's real GDP growth will slow significantly to around 1.2% in 2026. So that's about half a percentage point lower than what we estimate it was last year. So what is 1.2% growth? Well, that's well below the economy's estimated potential GDP growth. So meaning that the output gap or excess supply in the economy is probably going to widen, right? So another way of saying this is that basically inflation is going to moderate in 2026, right? So JP, we think the overnight rate has room to fall further in 2026. I understand that what we're saying here is quite different from consensus on interest rates because most forecasters are predicting either no change to the overnight rate or even an increase later this year. That may well be the right forecast, right? If the economy picks up materially. But for reasons I mentioned already, we think economic growth will weaken this year. And if we're correct about that, additional stimulus by the central bank should not be ruled out.
So if I'm trying to summarize, so Kuzma, and then Kuzma, the U.S. trade or the trade agreement with the U.S. and Mexico will have the chance to get back to it a number of times throughout the presentation because it does have an impact or potential impact across a lot of the different sectors. But with some of the headwinds on trade, and it's a positive to see the warmer relationship with China, and we'll again get back to that a little bit later. But some of the headwinds on trade, some of the headwinds, I really love the chart. We don't need to bring it back up on the screen, but I really love the chart about mortgage renewals because those 5-year mortgages 5 years ago were actually originated at the lowest fixed rate environment that we had seen in a long time. So that even if rates are relatively low, historically speaking, then that means that they're still going to have to renew at a higher rate. Talking about households, talking about businesses. So it does have an impact. And we're saying, if I heard you right, Christian, we're saying maybe potentially no rate movement in the first half of 2026, but maybe in the second half of 2026, if there is a movement, we think that it's more likely to be down than up, just because of some of the headwinds that we could anticipate for the Canadian economy. Let's talk a little bit more about fixed rates, because then really briefly, I always like to draw the comparison between the Bank of Canada rate, which is one thing, but then all the other interest rates are set by financial markets. And so what is the likely trend? So maybe a variable, we are where we are. We had a bit of a decline, steady, maybe a further decline, slight decline towards the end of 2026. When it comes to fixed rates, what can we say, Christian? Are we expecting the same pattern, or is that going to be something different?
I'll say different, right? So folks using variable rate products will benefit from lower Bank of Canada rates, if we're right. But borrowers who go for fixed rate products, in our view, may not get much of a reprieve, right? Because those products are tied to the 5-year Government of Canada bonds, whose yields are, in our view, unlikely to fall a lot over the next year. And that's because those long yields are highly correlated to the US bond market, right? So given the deteriorating US public, US fiscal position is really deteriorating. You have persistent inflation in the US, in part because of tariffs, and also the unpredictability of US policy, right? So we got an example this week, right? So because of all those things, investors are demanding a higher yield, right, to hold US government bonds. And that's unfortunately also pushing up Canadian long-term yields.
Yeah, so don't expect fixed rates to fall is what I'm hearing. So maybe just to close out the section on the macroeconomics, and we do provide a quarterly update, very specific forecasts based off those macroeconomic variables that do matter. One of those variables that I believe matter is the value of the Canadian dollar. It has a number of different influences throughout the agri-food supply chain, depending on the export position, import position. But what can we say about the likely pattern of the loonie in 2026?
Yeah, always tricky, right, to make currency forecasts, but it's given the complex dynamics at play here, in the foreign exchange market. But I'll give it a shot, right? So last year wasn't a good year for the US dollar, right? So that was a great opportunity for other currencies like the Canadian dollar to appreciate against the US dollar. The Canadian dollar did appreciate against the US dollar last year, but not as much as other major currencies, right? So, and part of a reason for the relative underperformance was the soft Canadian economy, right? And also our deteriorating trade deficit. So, but a major drag on the loonie, I think, was the yield disadvantage versus the US, because as you know, the Bank of Canada rate is much lower than the US Federal Reserve's policy rate. And I have a chart here that tells a story, right? So you can see on the screen, Canada's yield disadvantage is quite significant. And if, as we expect, that yield disadvantage doesn't change a whole lot this year, that would continue to favor capital flows towards the US instead of Canada. So all in all, I think fundamentals for the loonie aren't great. So I would say, considering the projected path for interest rates in both the US and Canada, a trending range of, I'll say, 72 to 74 US cents for the loonie seem reasonable to us for most of 2026.
Okay, maybe a little bit of upside from where we are, thinking about where we could end the year, but not that much of a movement. Okay, thanks, Christian. So we're going to move on to, as I alluded to at the very beginning, some specific analysis or some analysis to specific sectors. And we're going to start off with grains and oilseeds. So let me introduce another colleague of mine, our Deputy Chief Economist, Des Sobel. How are you, Des?
Good. How are you, JP?
I'm super well, thanks. And so let's talk about grains and oilseeds. I mean, in all the outlooks that we publish, we spend a great deal talking about the balance between supply and demand. I think it's always we always like to summarize some of the pricing trends through a statistics that we call the stock-to-use ratio. So what can you tell us about, globally, how are stocks, thinking of supply and demand trends, and what do you expect in 2026?
It's a great question, and thanks for everybody for joining us today. We look traditionally at supply and demand that determine commodity prices, and as you alluded to earlier, JP, these geopolitical risks that we're seeing, trade disruption, tariffs, are distorting the markets, and it's actually diminishing the significance of some of these traditional market fundamentals. But I don't want to discount it, so I want to focus on where we are from that supply-use standpoint. When we look globally, for most grains and oilseeds, excellent production this year, optimal growing conditions. We're seeing very strong supplies around the globe. You look at the US, they both had record corn yield and near record harvested area. So strong corn production, as well for soybeans, record yields. And so we're seeing really strong production south of the border as well. And while markets right now have been focusing on what's going on with the US and China, specifically exports of soybeans. And so we've seen that, there was a trade agreement signed. So there actually have been some soybeans moving now, or some fulfillment of contracts. I think the most recent announcement is they've reached their 12 million ton commitment target with US. This is still a long ways off from the 25 million target that they have set for the upcoming years. So that'll be something to watch really with the US and China as these dynamics, because that does influence demand for US soybeans, which does impact prices and does flow over into Canadian prices as well, specifically for canola. As well, we need to look at South America. So they are having their crop will be harvested soon. And then we've seen South America, particularly Brazil, starting to capture a lot more of that global export demand. So overall, good weather in Brazil. We're seeing actually increased acreage as well. So Brazil is becoming one of those main players in the export market. So that's pushing production up and prices down. So we'll be watching that as well. And the one thing to note is Brazil is actually getting more of the Chinese market. And so if we look back to 2019, China and the US had a trade dispute then over soybeans. So China went to Brazil and started sourcing from Brazil. And when that agreement between the US and China was resolved, China didn't go all the way back to the US market. They stayed with Brazil. And so we're seeing that dominance with Brazil going forward as well. And as you can see on the screen, when we take this together, this is the stocks to use ratio. So this is basically looking at what is the supply globally and what is the demand. And we can see for corn, it's been fairly flat. So even with that increased production, there's been only a slight uptick in the stock to use ratio, which means really strong demand still existing for corn. For soybeans, even despite that increase in the production, demand is increasing at a faster rate. So we're actually seeing that stocks to use ratio come down, which is continuing to keep those support prices somewhat. However, when you look at wheat, again, production's up, but demand isn't keeping pace. So we're seeing an increasing stocks to use for wheat. So that's going to weigh on prices as well.
The one thing, I mean, that I find interesting is wheat way up. I mean, significantly up. Soybeans slightly down. Corn's kind of moving upward a little bit, and then the U.S. production's kind of the stat that I really like was that production in the U.S. from 2024 to 2025. So that production that we're going to market in this current marketing year out of the U.S. that increase in production in the US is 4 times, more than, I think almost 4 times, to be accurate, almost 4 times the total production out of Canada when it comes to corn. So it's just like we're just talking about the increase from year to year being equal to 4 times production in the country here. So, well, let's talk about production here in Canada, I guess, is what can we say about how we've done, trying again to think of, like, this is the picture globally that we have in front of us, but if we abstract now from this, think of the domestic market, what can we say?
So last year was fantastic. Canada reached a record 107 million tons of grain and oilseeds being harvested. So that beat the prior record in 2020 by about 7 million tons, and it's 16% higher than the 5-year average. So that's something that's really good news. And when you look across the country, though, there was some variability. If we look in the west across the prairies, we had timely precipitation. We had really optimal growing conditions, so we actually saw record yields. However, when you look to the east, Ontario, there was some challenges there with drier conditions. So their production actually fell about just over 3% year over year. The further east you go, the worse it got. So Quebec and Atlantic Canada faced some much more severe drought-like conditions. And in Quebec, production was down 16%. In Atlantic Canada, was down about 18%. So it's very mixed across the country. West, really strong production, and the east, due to those dry conditions, there was some struggles for production last year. It's worth mentioning, because I think this is really important. When you look at some of the major crops, canola, lentils, and across all wheat varieties, production hit all-time highs. So when you look at it at an aggregate, overall, really good news on the production front, which really helped to support revenues in farm cash receipts in the ag sector.
It's hard, Des, impossible to ignore what has happened recently with regards to the trade relationship between Canada and China. Good news. I mean, well, we'll talk about canola for sure. I mean, there are different commodities as well that are not necessarily seeing the immediate benefit, but what can you tell us about grains and oilseeds, the Canada-China warmer relationships that are emerging right now?
I would say the signing of the trade agreement was a huge sigh of relief for the canola sector. And so we saw those punishing tariffs from 76% for canola seed. There's still a tariff in place. It's reduced down to 15%. But that's good news because that provides some certainty for the market and for producers on the upcoming planting season. As well, China eliminated the 100% tariff on canola meal. And so this is good news for the canola crushers in Canada, because what was happening is there was really no alternative market to China. So they were having to face some pretty significant price declines for canola meal. So overall, that trade agreement, it provides that certainty. So it's very timely heading into the planting season. So, producers can make those decisions on, what crops they want to plant. They have some certainty that there will be market access for canola this year. That's a good news story. I think the one thing to keep in mind, as a part of that trade agreement, it's effective March 1st. It's only a 10-month agreement. So it's only through to the end of the calendar year. So that's still a bit of that cloud weighing over the sector. So this is really why it's critical for the sector and for the government to continue these trade talks and negotiations with China, and looking at alternative markets as well. Diversification is key for Canada, as we're such an export dominant nation, and we want to reduce our exposure to the US. So that's one thing we have to look at for sure is these other opportunities to find export markets. So as well with this trade agreement, the other good news part of it is that it helps to offset some of the announcements coming out of the US related to their biofuel policy and potential changes. So that those changes are still being proposed, but it does look like it could have a negative impact on Canadian canola for sure. So that's good news that we open up the market access to China, because there's still some of this uncertainty with the US biofuel policy as well. And so when we talk about canola stocks, as you can see on the screen coming up here, there's a chart that shows how important the US market is and where our stocks to use ratio actually is in 2025-26 crop year. We saw a dramatic increase year over year. And like I said, this was due to record production. And you can see this did weigh on prices somewhat. But this was before the market reopened. And so I think that's what we really want to focus on is if the Chinese market, if we didn't regain access, we would likely see, even with average production, canola stocks to use increasing in Canada could have increased this year, which would have pushed those prices lower. So that's something to keep in mind, is that reopening of the market is critical, because regardless of whatever the price was, there really was no market for Canadian producers to move their canola. So they were, they're going to have to sit on the canola, store it, pay additional cost, lost cash flow because the market didn't exist. And as well, we look at Canadian canola crushing capacity. So there's another plant coming on this year. So that's going to be able to absorb some more of the canola production within Canada. It's really important to highlight our domestic crushing, our domestic value add, because investing in those types of operations or adding that to the sector also opens up diversification opportunities as well. So it allows us to diversify to other markets than the US. To put in perspective, the new plant coming online this year, I think total crush capacity in Canada is going to be about 15 million tons for canola, which is about 70% of the record production. So it just highlights how that canola crush is expanding and how important that is to the Canadian canola sector. And I do also want to talk about some other crops. So in the stocks to use, I did show wheat. Again, strong production in Canada. Demand hasn't been keeping pace globally, so we are seeing that increase in stocks to use for wheat. But despite that, what we're seeing in Canada is actually still strong demand. So our exports are still really strong. So I think that just highlights, Canada's wheat and how the global market it's desired for its quality, and safety as well. So we're seeing that, but it's still not going to potentially offset all of the increased stocks globally, which will still put some pressure on prices. And we might see some of that wheat being fed into the livestock sector as well. And then switching to pulses, this is one area which really has seen some dramatic price declines over the last year and a half. Probably, for lentils, I think it's up to a 50% price drop. Things aren't looking very optimistic as well because India still has import tariffs on pulses. So that's going to weigh on the prices this year as well. So prices where they're at might come down a little bit further just because of the lack of market access and the tariffs are being put on by India. The good news, though, is getting back to China, is that trade agreement we signed with China allows the removal of tariffs on peas. So it's a bit offsetting, but I think overall there's still some challenges in the pulse sector.
Yeah. The one thing that hit me this morning when I was looking at some charts preparing for this is looking at prices of the nearby future contract relative to the 5-year averages. And for all the crops, for all the crops, you're looking at a price currently or a near-term contract being lower than the 5-year, certainly lower than the 5-year average. And I would say even in some cases lower than the 5-year low, or the low of the previous 5 years. And so when I think of profitability, let's talk briefly about costs, and then we'll put it together, pricing and costs, and what does that look like for profitability?
Yeah, so the cost side, we're still seeing elevated costs. Our forecast is, overall farm expenses this year are going to rise about 4%, and even into next year. So it's not a good news story. We're going to still see that, farm expenses going up. And so I think we've said this numerous times. Each year we've done the outlook is this year is going to be probably the most expensive crop ever put in the ground. And so just to put in comparison, so I was looking up inflation, price increases over time. If you look back to 2019 is kind of our base year pre-pandemic. Overall farm expenses are up over 50% since 2019. In comparison, inflation in Canada overall is up 20%. So you can just see how much more significant the impact of inflation has been on farm expenses. And so, yeah, like you said, JP, when you factor in commodity prices that are softening near the 5-year lows, where input costs are right now, what you can see on the screen now is our estimation of crop margins. And so this is a representative farm. So just keep in mind that every operation will be a little bit different on their scale and efficiency. But what you really want to focus on is the levels and trends. And so on the figure on the left is a canola wheat rotation representative of Western Canada. You can see last crop here, there was a loss. This year, we're saying there's going to be a pretty thin margin this year. And this is before land costs. And this margin, what we're showing for this year, is really being driven by that record production that we saw. So it's not because of strong prices. It's just we had a really, really strong production, which was driving those margins. For next year, average production, where commodity prices are trending, we could see margins dip into the negative territory next year. So not a very good optimistic outlook. In Eastern Canada, it's a corn soybean rotation. Again, it's trended lower this year. Like I had mentioned, production was down. across most of the provinces in Eastern Canada. And so next year, our forecast is a slight increase because we're assuming a return to normal production or average yields next year. But whether you look east or west, well below that 5-year average. So margins are definitely are tighter. And so this is where we need to, for operations for individual producers, what can you control? And so this is really focusing on producers finding those cost efficiencies and focusing on productivity gains. Is that something that they can have within their control that can help improve margins? Even the slightest little bit would help.
Yeah, and even thinking of the margins and a little bit of upside for next year, certainly in Central Canada and Eastern Canada when it comes to corn and soybean. I mean, not even accounting for land costs. If you just build in, like, let's say, a rental rate equal to 2-3% of overall value of land, that gets you close to really break even. So, tight year for grains and oilseeds would be the message. There's a little bit like maybe some of the models that we have did not fully capture the upside. Let's say with implementation of Canada-China agreement, that would be one thing to consider. We'll see the export pace because that is going to determine at what pace the world market can absorb these larger volumes, right? Just not coming out simply out of Canada, but also of other producing countries. And so that's going to keep an eye. That's what we're going to have to keep an eye on throughout the year. So moving on, I mean, we got lots to cover yet, and we got short on time now. The cattle sector. I think that by far the biggest question we hear and we get is, how long is this cycle going to last, right? So can we expect prices to be this high for how long? So how would you answer this, Des?
So it's the flip side of what we're seeing in crops. Cattle, as very optimistic, really strong prices, feed costs that have come down. But in order to really answer your question, we need to look at the cattle cycle and where we're at. And so a cattle cycle, if you think from peak to peak or trough to trough, lasts that 10 to 12 years, give or take a few years, depending on other factors. So where we're at now, this figure on the screen will actually show cattle cycles since 1990, and you can see the cycles and how they vary in length. But the one thing to keep in mind is that they're fairly predictable in that you go through an expansion phase due to increasing profitability, and then prices start to flatten or decline, and then we see that contraction. So, if we look at historical cattle cycle, you can see that we're at the bottom right now. We're at the contraction. So now the question is there market signals that we're going to see expansion in the cattle sector? And so you can see this is very strongly correlated with price. You see those record prices and the low inventory. So this can take years, though. And one thing to keep in mind as well is I talked about market fundamentals, and what we've seen over the last couple of months is some announcements coming out of the U.S. about wanting to bring beef prices down. President Trump said beef prices are too high. Makes an announcement they want to increase imports from Argentina, and you just see the markets react quite quickly and volatile to that. So I think the question is, are we seeing those signals for rebuilding of the herd? And so in Canada, we're seeing a little bit of that happening right now. However, in the US, which is by far a larger market, we need to look at where the US is at. And though one thing that's really interesting coming out of the US is the number of heifers being kept for replacement, which is an indication of future growth in the cattle herd, is at a 75-year low. So it's very low. It's been, it's something that we're not seeing that rebuilding starting. And the other thing that we look at as well is the total number of cows and heifers that are being sent to slaughter as a percentage of total animals. And so there's a number, it's about 47%. Once that dips below 47%, that gives an indication that we're seeing an expansion in the cattle herd. And there's a big difference in Canada and the US. So in Canada, we actually see that ratio at 41%, indicating there are signals now that the cattle herd in Canada might be starting to increase. So that's a good news story that we're seeing that, for people that are wondering about retail prices of beef, we're starting to see that signal happen. However, in the US, it's still about 49% through 2025. So the US, we're still not seeing those market signals. And so that's going to continue to support prices. So the bottom line is the cattle sector set up for another year of strong prices. We're seeing moderating feed costs. So it's going to really support profitability, cow-calf producers, as well as feedlots. I think, I've heard this is, some of the best times they've ever had from a profitability standpoint. So we are at the bottom of the cattle cycle. That contraction should be stopping. We might see some of that market, the early indicators, it's starting to increase in Canada. US, not so much yet, but we'll be watching this. And for sure, the one thing to note is even if we start to see that increase in the expansion in the US, it's going to take years. So it takes the production cycle takes 2 to 3 years. So I guess bottom line is expect prices to be above that 5-year average, close to records, probably through 2026 and likely into 2027.
Yeah, and even if we were to start on an expansion, if you look at the pricing pattern in that first couple of years of an expansion, it's relatively flat, slightly declining. So you wouldn't lose much of the upside in prices if we were to start off a new expansion cycle. So thanks for that. Let's move on to the hog and pork sectors. So lots going on there. I'm tempted to say that trade might be one of the issues to monitor the most, but what can we just think of when thinking ultimately of profitability trends for the sector?
Yeah, so hogs very similar to cattle, had a really strong year. There's been, after several years of weak demand and global oversupply, but it seems the hog market is much more balanced. And we've also seen, because of the strength in the cattle sector, we've seen that spill over into the hog sector, and this is really being driven by the consumer. So we've actually seen the consumer shift consumption away from beef and consuming more pork. So that actually is creating some demand and supporting those hog prices as well. And as the crop sector does struggle with low commodity prices, this does actually help the livestock sector and lowering those feed costs. So I would say optimism in the hog sector is really high right now. We've got prices that are at the 5-year high and softening feed costs. So we're actually seeing margins for a farrow to finish operation in both East and Western Canada will be at their highest level in 5 years. So really good news from a profitability standpoint. But it isn't all good news. So you mentioned about some trade disruptions and different policies. The one thing that we're watching as well is that our exports to the US. And so one reason why they might be decreased is we're actually seeing an increase in slaughter capacity in Canada, which is a good news story. So again, this ties to more processing within Canada. Maybe that enables the ability to find these diversified markets that are away from the US. So that's a good news story. But you mentioned trade. What's been implemented on January 1st was something called voluntary country origin labeling, so VCOOL. And so in theory, this could reduce exports or reduce demand in the US for Canadian hogs. However, there are production concerns emerging in the US, and so due to disease. So they're actually seeing slowing herd growth. So this is still creating strong demand and margins for Canadian producers. I would say through the first half of this year, we'll see how these diseases unfold and whether or not this country of origin labeling will have an impact in the second year. But I think it's fair to say, from a consumer standpoint in the US, with record high beef prices and protein being a relatively more affordable protein source, there may be little appetite from American consumers to pay for higher pork prices due to labeling requirements, even if they are voluntary. As well, yeah.
Sorry, go ahead. No, sorry.
Okay, so I was just going to show you the next visual on the screen here. And this is our exports to the US, just to highlight how important the US market is. And so you can see different periods on there, but the US did implement country or mandatory labeling back in 2009. And so what we actually saw when that happened, exports dropped 50% that year compared to the year before. That was partially due to those labeling requirements. So the difference being this time, like I said, is the new labeling requirements are voluntary. So whether or not they're adopted is more up to the importers in the US and processors. And it's really difficult to highlight or quantify the market impact at this point. I think if you look at the US, I mentioned their supply, their sow herd has been declining for 6 years straight. So that still should create some strong demand for Canadian hogs as well. And then you touched on CUSMA and Christian touched on CUSMA as well, sorry. That's something that's going to weigh on the ag sector until we know what the agreement looks like, if it's reviewed or renegotiated. There's still that uncertainty. So when we talk about diversification, there's still strong demand in other countries, especially Japan. And we have these existing trade agreements that will help to, phase out existing tariffs. So we have to leverage those as well.
And the one thing I'd add is, when it comes to China, Canada, then, details TBD in terms of like what it would mean for the pork supply chain. So that's another thing too. So biosecurity would be one thing to know to watch in the US for sure. So thanks for that. Dairy, to me, it sounds as if I would say I like two things that seem to be important in dairy. One is the crave for proteins, and then the second one would be Kuzma again. Am I right, or anything else you'd highlight?
Yeah, you're bang on, JP. I would say, the dairy sector is riding this wave of protein, this protein craze. I, for one, I love protein, so I'm on this craze as well. And consumers are demanding more of this. And so this is, high protein dairy products, and they're willing to pay more for them. So this is really a trend that's reshaping the market. And this is happening. What's really interesting is this is happening despite a slowing population. Usually population growth is what really drives sales, but we're seeing this protein craze even in the absence of a growing population in Canada. And to give you kind of a sense of how much this has impacted the dairy sector, I'm going to pick two commodities, yogurt and ice cream. Year over year, consumption of yogurt jumped from 1.3% to 8.1%. For ice cream, it went from 1.2 to 5.9. So we're seeing that it's having a huge impact on consumption of protein products. And as well, it's not just traditional dairy. Food manufacturers are actually adding protein to all sorts of products, waffles, Pop-Tarts, and even Doritos. So this, I think this is what really opens up opportunities for whey protein as an ingredient in some non-dairy or non-traditional dairy foods as well. So what's happening is because of this craze, more milk boards are having to restructure their pool pricing for milk. And so, you can see on the chart that's coming on the screen here, there's a higher dollar value being placed on a higher protein. So you want to increase the protein and lower the butter fat. And so this will drive additional revenues for producers, which will then also lead to higher margins. And so this is an example in the Western pool. In the Eastern Canada as well, the pool would be following something very similar. So this is really a good news story for producers and gives them the opportunity to increase revenues and lead to higher margins.
Do you want to talk a little bit about Kuzma? I mean, it's hard to speculate, right? I mean, it's because it would be speculation. Like we don't know the outcome of like Kuzma. Two things can happen, right? There's like a review that needs to be delivered July 1st. At that point, the agreement, the existing agreement can be extended another 14 years, I believe, or 16 years, or 14, I believe, 2042. So that'd be 16. You get the idea. Or, you go from year to year with the prospect of seeing it kind of just being dismantled over a 10-year period. So bottom line is any speculation is what it is. That's speculation, but what else can we say? I mean, like potentially the US, kind of just thinking about market access, like how can they fit in more exports would be perhaps the one thing that would be to keep in mind.
Yeah, so a lot of uncertainty still exists with Kuzma. I think the one thing that I did look into was the U.S. Trade Office sent a report to Congress that provided some guidance on really what are the main sticking points with the current Kuzma. And so while there were many stakeholders that were like supportive of the agreement, wanted extended, there were some concerns, and specific to dairy, there was about market access. And what I think really caught my attention was that it was referencing the commitments negotiated under the current Kuzma agreement. So at the surface, it sounds like the U.S. is more, the sticking point is the current Kuzma agreement and the market access, the tariff rate quota access they have, and maybe looking to refine that to benefit U.S. Producers a little bit more. So it doesn't look like on the surface that it's going to be major changes based on what I've read, while being mindful that President Trump does love tariffs and things can change on a whim. But on the surface, it looks like more that existing Kuzma and the market access that was negotiated under that agreement.
And that domestic demand going up. or trending up is a real positive for sure in a context of zero or almost zero, near zero population growth in Canada. So, okay, let's try to do the next broilers and talk about the outlook for broilers in less than 5 minutes here. So, what I mean, high beef prices. I mean, lower pork prices. Chicken may kind of just like if I just put this on a 4-year time frame so that we kind of just get rid of the month to month, but like it's still a competitive protein. Like what else can we say about like the prospect or the outlook for chicken in the current year?
Exactly. So there's been a shift as well. We talked about beef, consumers shifting to more pork. We've also seen that towards more chicken as well. And so I think that has been supportive of supporting demand for chicken and has been reshaping some of how consumers have been shopping at the grocery store. So yes, chicken prices are still up, but the prices haven't increased as dramatically as what we've seen for beef. So I think the one thing to look at is really the number of chicks that were being placed into production. So the figure coming up on the screen, you can see where we're at this year, or sorry, in 2025. Those chicks that were placed into broiler production were near the 5-year max. And so this really does tie to what we're seeing for the demand for chicken across the country. And so this is actually helping support prices and support margins as well. So the growth is going to lead it into increased chicken production as well. So combined with lowering feed costs, what we can say generally overall is that aside of any type of avian influenza outbreak that might occur, if we can keep that constrained, the feed prices still remain fairly low as we're forecasting for in the crop sector. This is going to be a good news story. It will help support profitability in the broiler sector as well. And then keeping that eye on what's happening from a consumer standpoint definitely will weigh on potential demand as well.
Yeah, so production risk might be one of the things that turned out to cause a little bit of a different outlook, but overall seems positive. So let's just now focus our attention to food manufacturing, largest manufacturing sector in Canada, largest employer in the manufacturing sector in Canada. So I think I've always said, strong, robust, healthy food and beverage manufacturing sector is good for the entire supply chain. So Christian, I mean, 2025, I'm thinking of tariffs being a major news story and thinking as well as like consumers have dealt with quite a bit of food inflation. I mean, they're still dealing with significant food inflation. And we always say, well, we're lucky enough that we're in a sector for which consumers are not responding to price changes, right? You have to feed the idea that you have to feed yourself basically no matter what. But at the end of the day, consumers can make different choices when it comes to the type of products they're going to purchase, across the different products within the product, but different quality. So what was the year like in 2025? What are the factors that you think played out in 2025 that can have an impact in 2026 as well?
Yeah, so a year ago when we presented our 2025 outlook, we were somewhat concerned, right, about tariffs and household spending for the reasons you mentioned, right? So turns out that our concerns were warranted, right? So 2025 looks like an okay year in terms of nominal sales, but when you remove the effect of prices and only look at volumes, then the picture is not all that great. So volumes were actually down for a third consecutive year in 2025. And nobody really should be surprised here because manufacturers face really difficult circumstances, the most visible being tariffs. So it's true that most food and beverage products entered the US tariff-free thanks to CUSMA, but then even then, like you saw export volumes fall, right, sharply in 2025. So that highlights that there are still obstacles to move products across the border. So for example, additional costs to make sure that the goods are CUSMA compliant. And also we know China also imposed tariffs on some Canadian goods, which impacted our exports. So performance varied across subsectors. I won't go over each and every subsector or else, we'll be here the whole day. But what I can do is give you a high level overview by showing you the next chart. I think that tells you, that tells a story because it gives what happened to sales in some industries. And here the blue bar basically shows nominal sales and the green bar shows volumes, right? While the numbers inside the bars refer to the annual growth rate. And as you can tell, right, the impact of China's tariffs are visible, right, in grain and oilseed milling and also seafood. So tariffs on oilseeds were like really hit hard, right? Given that oilseed processing accounts for about 85% of that subsector sales. Tariffs on pork and aquatic products were smaller, but still notable, right? So those reduced exports. On a positive note, meat processors enjoyed higher sales, right? But we know that's entirely because of higher prices. Also registering higher sales last year compared to 2024 were processors of dairy products and a couple of others like sugar and confectionery, for example. Looking ahead to 2026, unfortunately, some of those factors that impacted sales last year, I think, are still present, and are therefore expected to influence sales this year as well, JP.
Thinking of next year, right? So CUSMA will likely be a major influence. I mean, I think we have, more than 97% of the actual Canadian food export that are exempt of tariffs. So obviously we need CUSMA to still be in play, still facilitate the trade between the two countries. But what do we anticipate, maybe thinking of domestically consumer here, like what is the outlook for consumers in 2026?
So yeah, so I gave you right at the beginning when we talked macro, I was basically telling you we're not that optimistic about consumers as a whole, right? Consumption spending as a whole. But and I get the reasons why. But when it comes to consumer spending on food, that's a staple, right? And it's not a discretionary item. So that's why we're a bit more positive on this one, right? So we think the next chart is going to help you understand why we're more optimistic here. And it shows the per capita expenditures on food and beverage are finally stabilizing, right? So you saw them decline, like per capita expenditure falling in 2023 and 2024, basically and now it's stabilizing, right? And if you look at the first 3 quarters of 2025 compared to 2024, Canadians bought more food, right? I think last I checked, it was around 1.2% higher compared to the same period, the first 3 quarters of 2024. So that's for us. We look at this and say, you know what, that's a good base from which sales can grow from, right? There's one caveat though, right? And so here we're assuming exports of food, for manufacturers, we're expecting exports of food and beverage products won't get any worse, right? So we acknowledge there's downside risk for some processes in terms of sales and revenues, but overall optimistic for sales. On the cost side, we're expecting a moderation, so much in line with our view that there will be a stabilization or even falling input prices, right? So you think of cattle, canola, cocoa, aluminum. Those are just examples where prices are expected to retreat slightly in 2025 after from 2025 after last year we hit record highs. So that should provide some relief to processors that use those things as inputs, right? So in addition to those raw materials, I'll say a softer jobs market is also something that will provide some relief in terms of wage growth for processors. So there lower growth in wage costs for those processors. So that should help, the moderation should help lower input costs as a whole. So all in all, you can tell from this chart here, is that we're expecting cost of production to moderate this year. So we don't want to be complacent here, right? So I'll say it's unlikely to be a smooth adjustment because there are still uncertainties out there, right? So like very complex economic environment with cost influenced by uncertainties, including trade policy. So bottom line here is that margins in the food and beverage manufacturing, in our view, should improve in 2026 with those caveats, right? But all in all, if we're right about margins improving, then that would provide a good base for businesses to restart investment again, right? So perhaps later this year or even in 2027 as trade-related uncertainties start to dissipate.
Yeah, and this is actually good news. If we do see the cost of goods sold and cost of production kind of come down a little bit, but then there is just also what all the other things that food processors have to deal with in terms of additional costs to make sure that they meet different requirements, regulations, and so forth. That's a different story, but I think there's some pressure still, but a little bit of upside on margins, which is a positive. So thanks for this, Christian. So yeah, we'll move to the last sector, farm equipment. This is a sector that has gone through a bit of a slowdown. If you look at the price of equipment, driven by a number of different things, pure inflation, but tariffs and steel and aluminum as well, that have had an impact on the pricing of equipment. Just the fact that, and we addressed this before in this event, is the tight profitability for grains and oilseed producers that are changing the incentives or the decisions that producers would normally make when it comes to upgrading equipment and so forth. So what does that look like in 2026 for the equipment market?
Yeah, I mean, good question. As you know, same factors that weighed on sales last year are still present, right? So last year, agricultural implement manufacturing sales fell, I think it was around 18%. So if you look at the last, the first 9 months of last year compared to the previous year, down 18%. So, and the two factors that weighed on sales last year, like you mentioned, right? Tighter farm profitability, high equipment prices. So that's going to continue. So that's why we think new equipment sales will remain soft in 2026. One thing that needs to be mentioned, though, that there's an apparent shift in how farmers approach equipment purchases, right? So you see farm operations now seem to be focusing more on cost efficiency. So how they do this, they either keep the equipment for longer or they explore options in the used market. So that's largely why we're a bit more optimistic about sales of used equipment this year. One particularly bright spot in the used equipment market is the rising demand for forage and haying equipment. And I've got a chart that shows this increase. So user baler sales, for example, used baler sales, so they were up over 37%, right? So 37% increase last year. And forage harvester sales have remained more or less steady. So those basically suggest there were upgrades in livestock operations, right? Particularly in Eastern Canada. So those folks were making, like decent margins, and they were able to purchase the equipment. So, for us, like overall, even though you're seeing overall, used equipment sales rise, we think its overall growth is going to remain modest. So coming back to sales of new equipment, so it's true that I said, we're not particularly optimistic, but producers, if they feel that good times will continue, will come back or will continue in some cases, like livestock, for example, and they see that profitability is something that will be there, so they could upgrade, right, their farm equipment, because don't forget, there's been years of delay, right, in terms of purchases of those farm equipment. So now if profitability comes back, then you could have investment again. Improve trade conditions, right? So that could also restore confidence and provide farm operations with greater certainty, right? So that would encourage more investment in equipment. So while we're not particularly optimistic, right, that's not to say there won't be opportunities, JP, that for manufacturers who can capitalize upon those opportunities.
Okay, so bright spot, that's good news. But then, the outlook remains under a lot of different uncertainties with regards to trade, with regards to tariffs, and with regards as well to the health of those operations that are buying equipment. So thanks, Christian, for this. Really appreciate it. So this is the end of today's event. Right on time. I know that we went really fast to all of the different sectors, but as I said at the very beginning, we're really leaning on an FCC website and the economic section, where you can find all of that information and more, and have the time to actually look at some of the specific projections when it comes to prices, and that can help in the overall strategic plan of the operation. If I were to summarize our outlook for 2026, this is going to be more of the same when it comes to the uncertainty of the different geopolitical events that are occurring right now. We don't expect that to be over by the end of the year. So when we are again checking in in 2020, early 2027, we anticipate that this is going to have to be a factor, decisive factor in the overall profitability trends. But there are the underlying fundamental factor that year to year are going to show up. Weather is going to be a major driver of profitability, right? We used somewhat of a bump in revenues last year for grains and oilseeds, because of weather patterns, especially in the prairies. It's been a bit more difficult, I acknowledge, in central Canada and eastern Canada. But the bottom line is that those, weather, biosecurity, when it comes to his livestock production, those kind of factors are going to still play a big role. But trade, I do think, is one of the essential issue that we're going to have to monitor under a number of different angles. We have warmer relationships with China. We're working hard to get that as well on the way with India. So those are the things that you have a commitment that we're going to keep monitoring throughout the year. So thanks for joining us and have a great 2026.